So hi guys, I have come up with a very important course for startups, for people who are doing startups or people who want to learn about startups. One thing, one term you would always hear about in all the startup circles, maybe inside your colleges, maybe inside your professional circle, is the valuation part. What is this valuation all about? And that is where I thought that I will make you aware about what is valuation all about, and in complete layman terms I'm going to talk about. So this course will cover the definition of valuation, what is valuation all about. We'll take a number of live examples to make you understand what is valuation all about. We'll talk about different terms and terminologies which are involved inside early stage startup valuation. We'll also talk about different methods of valuation which are used especially during the early stage of a startup. And at last, we will also look into how can you have the best model, for valuation for your own startup. And this is all, and plus a lot of other things is going to be covered in this particular course. So stay tuned, and I am going to see you just after this particular session, which is going to teach you what are the fundamentals of valuation. It's going to teach you the definition of valuation, and it's going to teach you the basic terminologies and the fundas and the terms which are involved inside valuation. See you soon.
Valuation fundamentals. So here we shall, delve into some of the fundamentals in case of, you are doing valuation exercise for your startup. So a startup valuation is a very important thing because all your funding, the way you actually divide your equity, it all depends on the valuation part. And since you don't have any data beforehand, the methods that you adopt in case of valuating your startup are a bit different from while you are doing the valuation for a well-established company which has already come into full-scale operations. So we shall study the fundamentals over here. So at the beginning, your startup is worth what you and the investor agree it is worth. So this is one thing which is very important, right? That at the beginning, your startup is worth what you and your investor think that it's actually worth. So as a founder, you must make sure that you develop a reasonable valuation range that the investors shall accept, keeping falling constant in mind. So see, it's, in the beginning, it's all about, what, you and the investor actually agrees for. So, you must have been knowing about an equilibrium graph, right? So, if this is the axis on which investor is quoting and this is the axis on which, founder is quoting, so, you have to reach some sort of an equilibrium point and this will be your valuation. So it depends a lot on, the negotiation between the investor and the founder. And this is what, decides your valuation point. Valuation means the monetary value of your startup, right? So I'll just take an example to explain you, what is this, monetary value, all about. A very, very layman kind of an example I will take. So let us suppose you make a pen, right? You have a pen with you and you make it, right? And then, you have to decide what will be the price of this pen. Now, once you have to decide what will be the price of this pen, you have to take a number of things into consideration. You can take a number of factors into consideration, and these are not exhaustive, parameters. Different people will come out with different sorts of parameters or factors to come out with the cost of this pen. Now, the first thing is that obviously I will, do a competitor analysis, right? At what cost are my competitors selling similar sort of a pen? This can be one of the ways, right? Second thing is that I will see, what are costs that I have actually incurred while designing this pen, while coming out with this pen. What are the costs that I've incurred? Now these costs can be anything. These can be the cost of your of you attending some conference as well, right? You attending some training sessions as well. You setting up a manufacturing plant as well, right? These can be a number of costs can be involved over there. So, you can think of all the factors that has actually, contributed to the cost. So once you take all these things into consideration, factor A, B, C, D, and so on up to E, F, and you add the cost over here, right? And on the basis of that whole sole cost that you have incurred, you will decide the price of your pen, right? You will decide the price of your pen. So this is what, this is how valuation goes. So while you're evaluating a startup, this means that you are basically finding out what is the total value, monetary value of a particular startup is all about, right? And while you have to do so, you have to take a number of, factors into consideration as well. So in very layman term, it is basically, the monetary value, or what a startup is actually worth of. So So you have to make sure that you develop a reasonable valuation range, right? That the investors shall accept, following certain constraints in the mind as well. So first constraint is investor will always want a low valuation before they put in their money. Founders will always want a higher valuation. There is no exact formula for determining early stage valuation. So as I've told, since you have got no data relating to your business operations at hand, and even if there is data, there's a very small data at your hand. So it all depends on a number of other factors, right? The valuation will decide how much equity ownership you give it to the investor, and the value of the company, that is the valuation of the company, depends on a number of milestones you have accomplished. And these milestones, right, whether you have got the product built, whether you have got some paying customers, whether you have got some patents filed against your name or the name of the company, all these factors will actually decide what is the valuation of your company. So we'll see each of these factors one by one. So investors will always want a low valuation before they put their money in. Why? Think about it, right? So let us suppose I tell that the value of my startup is 100 rupees. Let us suppose I tell that the value of my startup is 100 rupees. So if some person is putting in 10 rupees in this startup, right? So what is the amount of share he should get? The amount of share he will get will be the 10 rupees he has invested divided by the total value of the startup into 100. So that comes out to be somewhere around 9%. So 9% is the ownership that the investor means the person who gives you 10 rupees will get, because the valuation of your startup was 100 rupees. So he will get a 9% ownership, right? But if the valuation of the startup is 200 rupees, let us suppose. Now if I invest 10 rupees in this, now if the investor invests 10 rupees in this, what will be the ownership that he will get will be 10 divided by 110, and this comes out to be somewhere around 4%, right? So you see, if you increase the valuation, what will happen is that for the same amount of money invested, the investor is going to get a lower stake, the lower ownership. So the investor will always want that the valuation that you have decided for the startup, also known as the pre-money valuation. Pre-money valuation means the valuation you have decided before the investor investing in the money should be less, right? So the investor will always fight with you, keeping, to keep this amount less, so that by investing a particular amount of money, right, he or she ends up getting more stake, right, rather than getting a smaller stake. So this is why it is told that investors will always want a low valuation. But on the other hand, founders will always want a higher valuation, because they want to sell lesser stake, at a particular investment, right? So they want to shell out lesser stake, at a particular amount of investment. So there are opposite interest over here, right? So investor will always want a lower valuation before they put their money, and the founders will always want a higher valuation. Now, there's no exact formula for determining early stage valuation. This is what we have been talking about since the beginning. Now, since you don't have got exact data, since your business operations are not been running for a long period of time, right? So you don't have any exact formula for it. It depends on a number of factors, which we will see later on, inside this course, where we will see what all methods are being adopted for determining early stage valuation. Now, valuation will decide how much equity ownership you give it to the investors. Same thing, that 9% was basically the ownership that you are giving it to the investor, right? And it's also known as the equity, right? So ownership, equity is nothing but the ownership, right, that you are giving it to the investor. The value of the company depends on a number of milestones you accomplish. So, the more milestones you actually accomplish along, the life of your startup, the more will be the value of your startup. So all these, 5 factors have to be taken into consideration while you are coming out with a valuation range. And once you come out why it is said to be a valuation range, you should not pinpoint a particular valuation. You should have a range in your mind, right? If you have got a range in your mind, then only you can negotiate with the investor, right? If you have got a particular figure in your mind, you cannot negotiate. So that is why it is always told that you should have a range. You should decide a range, that this is the range in which I'm going to negotiate with the investor, and then I'm going to come out at a particular equilibrium point at which I would like the investor to shell money to me. And similarly is the case with the investor. At that particular point, the investor will actually give money to the startup and will get a particular stake inside the startup. Now, so as we saw, like as you keep on accomplishing the milestones, the valuation of your startup keeps on increasing. Why? Because as you keep on accomplishing the milestones, your risk keeps on decreasing, right? Your risks keep on decreasing. Let us suppose, like you have got your product built, so the risk associated with a product not being formed, maybe because of any reason, it goes down. You have got some paying customer, right? So the risk associated with that the product is not going to get any customers inside the market, that risk goes down, right? So as the risk associated with the startup decreases, the value of the startup keeps on increasing. Means the valuation of the startup keeps on increasing. Means if the valuation of the startup keeps on increasing, means what? Means you have to shell out lesser equity, lesser ownership to the investor at a particular amount of investment, right? So this is good for you, right? So it's usually advised, that the founders, always try to achieve as many milestones as possible before they go and raise funds, because if they do that, obviously they will be raising the same amount of fund, but they have to shell out lesser equity or ownership to the investors. Now, your reduced risk associated when you start achieving the milestone. So as we have already discussed that when do the risk reduce? When you start achieving the milestones. Milestones may be anything. Milestones may include increase in the number of paying customers, improvement in your product, onboarding of other people. You have established a good team of people within the startup, so obviously your risk will actually goes down, because since you have got good people in your startup, the chances of your startup getting successful is higher. As the startup matures with each investment round, the founder's equity keeps on decreasing, but the valuation keeps on increasing. So the founder's portion of ownership is effectively more. Now, see, like this is some point which has been discussed with this example, which you'll see. Like, let us suppose in the stage one, like in the in the beginning, right? You've got a valuation of 1 lakh rupees. Let us suppose 1 lakh rupees, and it's only you, like it's only the founder who is there. So you have got 100% stake over here. So your total worth is 1 lakh rupees. But now then you achieve some of the milestones, right? And because of those milestones, right, the worth of the startup now has become 1,50,000 rupees. 1,50,000 rupees is your worth now. Now let us suppose you have also given out 20% stake to your investor at some particular amount, let us say, right? So now your equity becomes 80%, but 80% of 1,50,000 is still 1,20,000. So your worth has increased, although your equity has decreased, but your worth has increased. Similarly, you achieve another milestone, you raised another round of funding, so you sell out another 30% to the investor, right? So right, so now you have got only 50%, but your valuation has now become 2,50,000. So your worth has again increased. So what is happening is that if you talk about in terms of the graph, if you talk about, right, so what is happening is basically the founder's equity is keeps on decreasing, but the founder's worth keeps on increasing, right? But the founder's worth keeps on increasing, and ultimately in the fifth stage, right, where you've got 1, 2, 3, 4, 5, 6, 7. So 1 crore is the valuation, right? And you've got just 5%, right? But you still, you know, your worth is 5 lakh rupees, which is way ahead than 1 lakh rupees. 1 lakh rupees was having 100% equity, but 5 lakh rupees is having 5% equity. So this is how if you would have observed, like in case of Flipkart, right? Mr. Bansal exited with 1% equity, but it was approximately around $1 billion, right? So as a startup grows, as a startup matures, your valuation keeps on increasing. Your equity will decrease, obviously, because you will raise a lot of funds, and you will sell out, some equity or ownership out of your own equity, but your worth keeps on increasing because the value of your startup keeps on increasing, right? So this is one thing which is very, very important. Now, valuation and funding terminologies. So let us see the important, valuation and funding terminologies associated. The first term is the pre-money valuation. What do you mean by pre-money valuation? The value of a startup before an investment round. Value of a startup before an investment round. This is important as the funding and the related discussions are based on this. So before you go for a funding round, before you go to the investor, you decide on some value of your startup. And that value of the startup is known as the pre-money valuation. Post-money valuation will be nothing but the pre-money valuation plus the investment amount that you have raised, right? Plus the investment amount that you have raised. So your pre-money valuation plus the investment amount that you have raised will become your post-money valuation. Founders dilution. This is the amount of ownership given up by the founders in return for some investment from others, let's say angel investors, angel groups, VCs, or even friends. So obviously, if you raise some funds from the investor, you as a founder have to dilute some stake from your own stake, right? Stake means ownership, means equity. All the three terms means the same thing. And that stake that you have to give, is basically known as the founder's dilution. Dilution means your stake has actually decreased. So let us take an example. Say the founder is ready to dilute 40% stake for $1,000. What does it mean? It means that if the pre-money valuation is $500, the post-money valuation will be $1,500. Why? Because post-money valuation will be pre-money valuation plus the investment that is there to come. But for this investment, the founder is going to dilute 40% of his stake. So initially, if it was 100% stake that was there with the founder, finally he will be having only 60% stake. So his worth will be now 60% of post-money valuation, that is 60% of 1,500, that is $900. So you see, right, his worth has become 500 to $900, but his equity has decreased from 100% to 60%. Right, so this is what is known as founders dilution. Like founders dilution is, right, the equity stake that you actually shell out for getting some investment from the investor. Investor dilution. Now, this is the amount of ownership given up by the previous investors in return for some investment from others, say angel investors, VCs, or even friends. So what happens is that once this investor, who has invested $1,000 in your company, has already invested that amount, so he becomes, he kind of becomes an owner of the company now. Now, if you go for the next round of investment, what happens is that alongside the original founders, this investor also has to dilute some of his stake, right? So that will be known as investor dilution. So the people who are already a part, who have already invested in your company, right? Once you go to the subsequent round of investment, even their equity will get diluted, even their ownership will get diluted, and this is what is known as investor dilution. Investment round. Now there are different names that have been given to investment round. So to start with, it is called a seed round. Then once you are with the, so what happens is that usually initially the investment is being raised from friends, family, etc. Then you go to angel investors, angel groups, and then you go to VCs, VC groups, and all, right? So initially it is known as the seed round. Then once you get into the VC round, right? VC round, it starts being called to be series A, series B, series C sort of round, right? So this is how you call the investment round. Now, talking about a down round. So what do you mean by down round? When the founders accept an investment at a lower valuation than the previously established valuation, right? So let us suppose, in the first investment round and in the second investment round, right? In the first investment round, your pre-money valuation was 100 rupees. But in the second investment round, your pre-money valuation has come to 80 rupees, right? So what happens is that in the second investment round, if you are raising 10 rupees, you are giving away how much equity? 10 by 90, that is 1 by 9. That is equals to 11%. But the initial, in the previous investment, if you're raising 10 rupees, you're giving only 9% equity. So what has happened is that, instead of the pre-money valuation being increasing from one investment to the other investment for subsequent round, what has happened is that your valuation has actually decreased. There may be various reasons for this. Maybe, initially once you raise that investment, there were some expectations from you, to actually fulfill, but you were not able to fulfill those expectations, and because of which your market value, your valuation kept on decreasing. You're not able to achieve the milestones, and that is why your valuation kept on decreasing. So down round is not considered to be good for a company. Down round is happening. This means that the company is not performing well on various metrics, on various performance metrics. So this is something which, startups should avoid. That down round should not happen inside a startup, because this is considered to be not good for the company. Seed round. Seed round. What do you mean by seed round? It means that this is any investment used to start the company, right? These include money coming from founders, family, or other support. So seed round is the initial thing, right? You don't go to, you don't formally go to the market, you don't formally go to the professionals to raise money, right? You use your friends, your family, other support members, to raise an amount so as to start a business. Now, Series A, Series B, as I told you earlier, once you enter into the VC round, right? VC round, your funding, what your rounds, your investment rounds starts to be being called Series A, Series B, Series C, etc. Equity, as we already know, equity is basically nothing but the ownership in a startup. So equity is nothing but the ownership in a startup. Either you call it equity, you call it ownership, you call it a stake, everything means the same thing, right? Equity, ownership, or stake, it means the same thing. Now, why is pre-money valuation so important in the beginning of a startup, right? Why is it so important to value your startup, to determine a monetary value for a startup before you go for an investment round, right? Why is pre-money valuation so important? The first thing is that, in order to develop a funding plan, right, this depends on the kind of a startup and the sector in which you are serving. So in order to develop this funding plan, right, if you're into manufacturing sector, you have to establish a number of plans. You will need, funding at different intervals. If you are into service sector, you have your funding plan, at different levels, right, at different periods. So in order to develop that funding plan, it's very important, for you to come out with a pre-money valuation, right? Because once you have that pre-money valuation in hand, and then you can determine, this is the investment, this is the X amount of investment I have to raise, so how much equity I can dilute to the investor, right? And once you have this figure in your mind, then only you can uh, you know uh, you can find out, like, for raising this much amount of investment, how much equity stake can I raise. Likewise, you can plan it in the, like, in part one of, I just want to sell out 20%. In part two, I just want to sell out 10%. Means, in round one of the investment, in round two of the funding, right? I just want to do that. So on the basis of, you have a pre-money, on the basis of this 20%, you will decide on the pre-money valuation. On the basis of that pre-money valuation, you will find out, this is the investment that I should require from the market. So, in order to develop this entire plan, right, of your funding plan, it becomes very important to determine, first of all, determine what is your, as is, right now, monetary value of your startup. Once you have that, right, you can actually go on and decide on your funding plan. Second important thing is that, you need to know a pre-money valuation so as to start discussions or pitch with the equity investors. So only once you have a pre-money valuation in your mind, or maybe pre-money valuation range in your mind, right, you can have a discussion, you can have a negotiation with the investor, talking about, what is the valuation at which they are ready to, invest in your startup. So in this aspect, pre-money valuation again becomes very important. Third is for stock incentive plan for employees. So for this thing, it's very important, especially in case of startups. It has been seen, like, startups offering, a stock incentive plan for their employees, as a kind of a benefit to them, because, as the startup grows, these stock incentive plans become very nice incentive for the employees. So we'll study about this later inside this course, how this stock incentive plan is being done for the employees. So for this thing also, determining a pre-money valuation becomes very important. And the next thing, the fourth thing, but, the primary thing, I would say, for equity split amongst the co-founders. So unless or until you have a value in your mind, you cannot, split the equity amongst the co-founders. So let us suppose, I will just take a very crude example. Let us suppose, you determine that 10 lakh is, your the value of your startup. So you have got 3 founders with you, right? So on the basis of that, you will say that you have to invest X amount, you have to invest Y amount, and you have to invest Z amount, and on the basis of this you will get some P% equity, some Q% equity, some R% equity. Or you will define the responsibilities, like you have to invest X amount plus you have to do this responsibility. So everything starts from deciding this value, right? Once you decide this value of your startup, right, and then only you can divide the equity amongst your co-founders. So this is something which is very important. So these are all the reasons for for deciding the pre-money valuation of your startup, and these all things have to be kept in mind.
Now, let us look into the valuation equation. Valuation equation is a very interesting equation, and we'll look into it. We'll do the DNA analysis of that. Let us meet just after this.
What is the valuation equation? Valuation equation is very simple. We have already studied it. Pre-money valuation, that is your valuation of the startup, that is the monetary value of the startup before you're going for an investment round, plus the investment that you get will be equals to the post-money valuation, right? Post-money valuation will be equals to the post-money valuation, right? So this is what defines your valuation equation. And as we have already known, that investors will always target a lower pre-money valuation, because investors will always think that of getting higher equity, higher stake, higher ownership by investing the same amount of money. On the other hand, founders will always strive for a higher pre-money valuation, so you always have to strike an equilibrium. You always have to negotiate and come out with an equilibrium point. And that is why, that is the reason we never have a pre-money valuation at an exact point. We always decide pre-money valuation in a range, so that we can negotiate it with the investors. Now you have to reach an equilibrium, right? And that equilibrium becomes your final valuation. So this is valuation equation. Valuation equation is nothing but pre-money valuation plus investment amount is equals to post-money valuation. Now let us see an example to showcase the calculation of founders' equity dilution or investor ownership percentage. So you have got a pre-money valuation with you, right? And then you go for an investment. And what happens in case of investment is that the investor gives you some money, X amount of money, but this guy who is the investor will give you some X amount of money, but he will take some Y% of ownership of that company from you. This is what happens in case in very crude terms, in very layman terms. So let us see an example, right? So say the pre-money valuation is agreed upon, that is after all the negotiations happening, right? The pre-money valuation has been agreed upon at $1 lakh, $1 lakh US dollars, and the investor has agreed to invest 20,000 US dollars in that. So what will be the post-money valuation? The post-money valuation will be pre-money valuation plus the investment amount, that is 1 lakh plus 20,000, that becomes 1 lakh 20,000 US dollars. What will be the investor's ownership in this? Investor's ownership will be the amount of investment which investor has made divided by the total valuation, that is the total post-money valuation, that is 1 lakh 20,000. It comes out to be 16.67%. Founders equity will be obviously 100 minus 16.67, so that becomes 83.33. So see, founders equity has decreased from 100% to 83.33%. So that's what is known as founders dilution, right? And the investor ownership has increased from 0% to 16.67% at what investment? At 20,000 rupees, 20,000 US dollars of investment. So founders equity has decreased from 100 to 83.33%. So founder has suffered a dilution of, so it is said that founder has suffered a dilution of 16.67 ownership at 20,000 US dollars ka investment. And on the investor side, it is being said that investor has agreed for an investment of 20,000 US dollars at 16.67% ownership. So this is how we can actually in terms of calculations we can actually portray what happens once an investment happens. So an example just to show the calculation of founders equity dilution or investor ownership percentage, how to calculate that.
You have got to raise funds. You have identified that this is the amount of money, this is the amount of capital that I need in order to make sure that my startup grows. But how do you express your fundraising goals to the investors? Let us look upon this inside this particular session.
Now, the another thing which is very important while you are going to raise funds is how can you express your fundraising goals to the investor? How can you express your fundraising goals to the investor? This is one thing which becomes very important while you are going to raise funds. So one of there are couple of approaches that we will be discussing over here. The first approach is you talk in terms of the investment amount and the equity dilution expectation. That is, you go to the investor, you as a founder go to the investment and you tell that we want 50,000 US dollars and we are ready to sell out 20% equity ownership. So you are talking in terms of the investment that you want and the equity ownership that you are ready to dilute. That is the equity dilution that you are ready to undertake. So if you're telling to the investor that you want 50,000 US dollars at 25% equity, this means that the post money valuation for you become 2 lakh US dollars. How 2 lakh US dollars? So 50,000 makes 25%. So 100% will be this 50,000 into 4. That becomes 2 lakh US dollars. So if you're telling to the investor that you want 50,000 US dollars at 20% equity, this means that you're telling them that for me the post money valuation is going to be 2 lakh US dollars. And now once you have the post money valuation, how can you calculate the pre-money valuation? Or the post-money valuation minus investment raised. So the post-money valuation is 2 lakh, right? And you subtract, the investment raised, that is 50,000 US dollars. So that comes out to be 1.5 lakh US dollars, right? This will be your pre-money valuation. So this is one way of expressing your fundraising goals to the investor. That is, you talk in terms of the investment that you want, and you tell that this is the amount of equity that I can actually dilute for raising this amount of investment. That is, I can give it to you for getting this much amount of money from you. The second approach is that you talk in terms of the investment that you need to raise, and you talk about your pre-money valuation. So you talk about the investment and then you talk about the pre-money valuation. These are the two figures that you give it to the investor. So you go to the investor and you tell that I want to raise 10,000 US dollars from you. I want this much money from you, and I have got a pre-money valuation of 1 lakh US dollars. This means that what you are actually telling it to the investor is that your post-money valuation will be pre-money valuation plus investment, that is 1,10,000 US dollars. So your equity becomes that is 1 lakh US dollars is your pre-money valuation divided by the post-money valuation, that is 90.9%, and the investor's equity will be 10,000 because this is the fund that you're going to raise, divided by the total the post-money valuation that you have, that is 9.1%. So if you're telling to the investor that you want to raise 10,000 US dollars at pre-money valuation of 1 lakh US dollars, you're basically telling to the investor is that I want to raise 10,000 US dollars from you and I can give you 9.1% equity. This is what you are telling to the investor. So these two approaches are being used by startup founders, by early stage startup founders, to raise, to pitch their fundraising goals to the investors. You can adopt either of the two approaches, or you may either come out with another approach of your own. So and this is this is very creative, right? So and that is why it is told that while you are doing the valuation of an early stage startup, it becomes very creative, because you can come out with your own factors as well. Now inside the industry, there is a trend that the maximum investment that you should raise should be less than or equals to the pre-money valuation divided by 2. So let us suppose you've got a pre-money valuation of 100 rupees, so you should avoid raising anything more than 50 rupees, right? And it's usually an industry standard that people will not give you more than 50 rupees in most of the cases, right? So if your pre-money valuation is higher, you can raise higher amount, but the maximum amount, the maximum investment that can be raised, which is a market standard which is there, right, is the pre-money valuation divided by 2. This is the maximum amount that can be raised very easily, right? And so this is something which you should have in your mind while going to raise an investment. You should not tell to the investor, like, if you have got a pre-money valuation of 100 rupees, you should not tell the investor that I want 80 rupees, because that gives a bad reputation, because the market standards tells that you should always pitch for an investment which is less than or equals to the pre-money valuation divided by 2.
Now we are going to talk about some of the common mistakes of valuation which are being committed by early stage startups. It's very important to avoid them, and it's very important to be very much sincere while you're watching this particular session, because you should avoid these mistakes. You should not commit it.
So some of the common valuation mistakes which are made during the early stage of startups is what we are going to see over here. What are some of the common valuation mistakes that are being made? And these all mistakes should be kept in your mind while you're actually doing valuation for an early stage startup, just to avoid these mistakes from basically happening. The first one is an equity deal early on the life of a startup leads to diluting equity at a mere capital infusion or investment, and then later it becomes very difficult for the startup to explain such equity dilution to an experienced investor. Now, what it means is that if early on, right, if early on inside the startup, you need some money, maybe to build up the product, maybe to create a kind of a team or maybe infrastructure. So what happens is that you are in need of money. So usually what ends up is that कि you raise a small amount of money but you give a large amount of equity if you're doing an equity thing over there. So right, so you started, you did a startup, right, and you had limited amount in your account, but you you really wanted to build this startup. So what you did is that you went to some person, right, and you took some Y amount from him. You needed the money, right? This person gives you Y amount of money, and this person knows pretty well that your product is not built. So this person will negotiate very hard with you, and you ended up giving some Z% of equity to him at Y amount of money. Now let us suppose this Y amount of money was not that big money. Let us suppose it was 2 lakh rupees, let us suppose, and for that you gave away 30% equity. Just suppose. So for 2 lakh rupees you gave 30% equity to this person. You had your own problems, right? Because you needed money at that point of time, you had to do this. But what this actually lead to is that once your product is ready and you go to the market, right, you go to the market to raise some funds, and then inside the market there will be investors, and to these investors what you tell is that I want 1 crore rupees, but I will give you an equity stake of 30%, let us suppose. Now these investors will ask about your history, and in history they will find out is that in the beginning of your startup you had taken 2 lakh rupees from a particular investor and had given away 30% equity, and this thing will become very difficult to justify over here, and that is where your negotiation power will actually go down. So just because of these all, just to avoid these all things from happening, it's usually advisable to raise capital in case of in case it's the early stage, from friends, family, and all, and that capital should be raised in the form of loans, right? It should not be in the form of equity. So there's a difference between equity and loan. You go to the bank, right? You take some Y amount from the bank, right, and the bank charges you interest on that. So bank basically gives you loan, right? This is your company and your company took Y amount from this bank, so you have to pay some interest along with this Y amount to the bank. You don't have to give an equity, you don't have to give the ownership to the bank, right? So similarly, if you are lending money from your father, let us suppose, so you have to give back this amount, or with an interest to your father, right, or maybe to a friend, but you don't need to give an equity and ownership. So it's usually advisable, like in the earliest stage, if you want some money, better take a loan, or better take it from your close, near and dear ones, where you will not require to shell the equity, right? And this will actually help you in the later stage while you go to the market, while you tell to the investors, right, your investment needs, your negotiation power increases in that case. The next is, if you value the startup very high in the beginning itself, so your product is not ready, so it's in the beginning stage, the chances of a down round valuation is very high. It may also lead to investors losing interest in investing in your startup. Now, sometimes what happens is that the founders, value, once they do the valuation, they value it very high. Let us suppose, I did a startup, right, and my product is not ready, my team is not there, right, I have not hit the market till now, but still, I valued it, very, very high, right? So what will happen is that there are two things that can happen. First thing is that either the investors will not take interest in investing in your startup, so you don't get money, And the second thing is that even if you find some investor, who is investing the amount, maybe he will take a lot of equity from you. If he invests the amount and he's investing the amount at this particular valuation, right? So your chances of a down round is what? That next time once you go for the investment, right? Your chances of this valuation coming down means you raising amount at a lesser valuation as compared to this is considered to be down round. And down round is considered to be very, very bad for any startup, right? It actually reduces the confidence of founders, the employees, the market, as well as the investors, the existing investors. So if you have valued your startup very high in the first round itself, and it's unjustifiable because your product is not ready, your team is not there, etc., etc. You have not reached any considerable milestones. The chances of your startup getting into a down round means that once you go to the next round of investment, you have to raise money at a lesser valuation than the previous valuation that you had in the previous investment round. That chances increases, and this is considered to be very bad for any startup, right? So it's advisable that you once you are doing valuation, right, keep it a very give it a very optimistic figure, right? Take all the points into consideration, so so as to avoid these two cases from happening, right? Now the third thing is that no customer validation but high valuation is a big mistake. As we were talking about just before, all investors look for customer validation in the form of registered user or paying customers or similar. If you have valued your startup very high, but you don't have any paying customers, you don't have a lot of signups on your site. Let us suppose, right? If you have an edtech site and you are an edtech player, you don't have signups, you have not reached to the market, you don't have paying customers, still you have valued your startup very high, right? It doesn't give a good indication to the investors, right? So better avoid these mistakes. Either you don't go for an investment round at that point of time, right? Or if you've gone for an investment round, make a justifiable valuation before going towards the market. Otherwise you will not find investors, or even if you find the investors, your chances of hitting the down round becomes very high. The next is, don't value the idea or market potential, identify the real milestones, right? So it's usually seen, right, a lot of value being given to an idea, right? Yes, idea is very important. Everything starts from an idea, everything starts from a dream, but then its execution, the real milestones in forms of number of customers acquired, number of geographies covered, whether your product has been completed or not, or it's still in the testing phase, you know yeah, whether you have developed your team or not, if you have developed your team, what kind of a people are there inside a team. All these real milestones have to be taken into consideration. Just an idea or market potential, just saying that this is a very good idea and this is going to hit the market like anything, it's not, it's not considered to be justifiable, for a particular valuation measure that you present to your investor. So take care of this thing. The next thing is that valuation, equity, and raise amount disconnect. This is one thing which is common, is that you have to take care of what you say to the investors justifies your pre-money valuation, right? So it's very important, right? Just in the previous video we were talking about, your the maximum amount that you should raise should be equals to your pre-money valuation divide by 2, right? So if your pre-money valuation is, let's suppose, 10 lakh rupees, and you have gone to the market asking for 30 lakh rupees, right? This doesn't seem to be justified enough, right? So there should not be a disconnect between what is your pre-money valuation, what is the equity that you are ready to offer, right? And then and the raise amount that you are wanting to have, right? So raise amount means the investment that you want, right? The next point is, valuation is not the only important thing while raising investment. Very, very important points. Valuation is one of the things. The other important factors include seat at board of directors, liquidation preferences, voting rights, etc. So investors, who actually come to invest in your startup, they're not only looking at the valuation part. Valuation is one important thing, but they're also looking, what all other powers that they will get if they invest in your startup. Whether they will get a seat at board of director level, whether the liquidation preferences means, you know, um, liquidation preferences We'll study it in the coming videos, but just to give you an idea of it, right? It's more about, if you have got something called preferred shares, right? So your shares, will be will get preference over the common shares, right? So your liquidation, you have got a liquidation preference, right? So this is something which we will cover, in details in the later video. The voting right, just to give you an idea, we'll again be covering this aspect as well. Is that like generally, if, for one share somebody gets one voting right, but for one share you get two voting rights, right? So that is where you have higher voting rights as compared to normal shareholders. So valuation is just one thing. The other factors include seat at board of directors, liquidation preferences, voting rights, and other factors as well, which we will see in the next videos to come. So as we discuss the first point, it's good to delay setting the valuation of the startup. In the beginning of the startup, it's better to take loans. It's better to take money from your friends, family, etc., rather than going for an investment and shelling out a large amount of ownership just for a small amount of money, because it becomes very difficult to justify that once you really go for an investment, right? As we studied in the, just some time before, the first mistake which many of the startups do commit. Now let's talk about down round. We have heard, although I've told the basics of down round, and this is what you need to know. It means an equity investment at a valuation lower than the previously established valuation, as we've already talked about, right? So you're going for an investment, you are asking for an investment which is at a lower pre-money valuation as compared to the valuation that you had in the previous round. Down round is considered to be very bad, right? What can be the causes of this? Is that you are raising too much investment very early. So one of the reasons we have already discussed is in that in the very early part, you have raised a lot of investment, right? And you have not been able to fulfill the milestones, right? And your burn rate is very high. Burn rate means you're burning the invested amount, right? Let's suppose you got 2 crore investment and you are burning this amount at a very fast rate as compared to the customers that you are gaining, right? So your burn rate is very high and you are not able to achieve your milestones, right? All these things lead to lesser valuation. What happens is that in the first round, you went to the market, you told that at the end of 6 months I will be acquiring 1 crore customers, and with that promise you raised, let us suppose, 10 crore rupees, right? At that particular valuation where you consider that 1 crore customers you'll acquire in 6 months, but after 6 months you were able to acquire only 10 lakh customers. So what has happened is that you have already consumed the 10 crore rupees which you raised in the previous round of investment, but you have managed to achieve, you only 10 lakh customers, means you have not hit the milestone of 1 crore customer. So once that happens, the confidence of the investors in your startup starts decreasing, because your burn rate, right? Your burn rate is very high, but your milestones are not being fulfilled. So in that case, what happens is that your valuation decreases, right? Investors are not ready to give you money at the previous valuation, right, which you had in the first round. Now they want the valuation to be decreased, and you have to do that. Why? Because you have not achieved the milestones, right? So so a download is not considered good for a startup, right? It's not considered good for a healthy startup, since it affects the founder's motivation. Obviously, your motivation as a founder will actually keep on decreasing if it's a down round, and it has effects on other stakeholders and employees as well as the market, as well as the investors, right? So no, this is very demotivating. So it's usually not advisable to have a down round, right? And a startup should make sure that they don't have a down round. So the strategy of investment, the strategy of fundraising should take this into consideration as.
Now we are going to talk about all the factors which affects the pre-money valuation of your startup. Many factors. It may not be all inclusive, but I've tried to cover as many factors as possible which do affect your pre-money valuation. And I hope you do understand what is pre-money valuation all about. If you don't know about it, please go back and cover that inside the beginning, the sessions which were there at the beginning. See you soon.
Now, factors for determining early stage pre-money valuation. Now, what are all the factors that have to be taken into consideration while you are doing the valuation for an early stage startup? The first factor are the company factors. Now, what are all the company factors that are taken into account? First is the founders and the team, right? qualification of your founders, the past experience of your founder, the composition of your team, the experience of your team, all these factors are taken into consideration. If you have got a very good team, if you have got founders who have already got experience into startups, your valuation, you can increase your valuation accordingly, right? So this is one factor which is taken into account. The second factor is the market size. Market size means what is the market size which the startup is going to serve. So what is the market size that you are actually going to serve, right? Last players there inside the market? So are there already last players inside the market? This question is very important. Is the market large enough to accommodate enough competitors? This question is also very important, right? So first thing is that, is the market size large enough? Are there already some competitors? If there are less competitors, you have greater chance of occupying a bigger market, right? And if there are already competitors, right, but if the market size is very big, if you still have got good chance. But if the market is small, right, and you have got a number of competitors over there, it really becomes difficult for you to take away market share from the existing competitors. So all these questions become very important while you are doing valuation for your startup. The next thing is the revenue projections. Now, revenue projections for 3 to 5 years, so you have to project your revenues, and for projecting revenues also you have to take many things into consideration, right? The growth rate of in the number of your customers, in the number of signups, in the number of logins, the geographies that you are going to cover in the coming years, and many other factors have to be taken into consideration. The ticket size of the product you're going to launch, what will be your revenue model. So all these things have to be taken into consideration while you're doing projections for revenue, which is for 3 to 5 years, which is again very important factor while you're doing pre-money valuation for your startup. Revenue projections vis-a-vis the market size is very important, right? So as such, revenue projection is not that important, but revenue projection with respect to the market size is important. So let us suppose I've got a market size of 2 crore, so, and my revenue projection is like 10 lakhs, so let us suppose 20 lakhs. So this means that I'm telling I'm occupying 10% market in 5 years, right? And if my market size is, let us suppose, only 20 lakhs, and if I'm occupying 10 lakhs, the revenue projection means I'm going to cover 50%. So this is a bigger market size that I'm going to cover. So it's important that you take the market size into consideration as well, right? So usually the investors see revenue projections in comparison to the market size that is there, right? The total market size which is there. So for you, the first thing is also to find out what is the total market size that your business can actually serve, and with respect to that, what is your revenue projection. So this is something which is very important. The next factor which is there is technology or product. So does your technology offer significant advantage to the customers? Is it a game changer, right? Or it's just a merely good to have option, right? So both things are important, whether your technology is a game changer or it just have a good to have option. So this is where you have to define what your technology is all about, and once you're doing that, again you have to take a lot of factors into consideration in that. The other important factor is the competition, right? What are all the competitors over there inside the same market that you're going to serve, inside the same category, product category, maybe anything, right? And do you have any differentiation from those competitors? Then intellectual property is another factor. Do you have patents and all? Do you have if you see the automobile market, Volvo has got a lot of patents in terms of safety features, that actually gives it a kind of, if you talk to any of the salesmen who is selling Volvo cars, he will always talk about those patents. He will always keep on talking about those patents, because that is what gives it an upper hand, right? So if you have got some patents, right, for your product, for your the which you are developing, right, it actually adds it actually gives a good indication to the investor, right? So this is one factor which is again considered, that is the intellectual property. Customer traction is another very important factor while you are doing the valuation of an early stage startup. It includes cost to acquire new customers vis-a-vis the lifetime value of the customer. Now what does it mean, right? Now let us suppose I am your customer, right, and you are the salesman, and you have to impress upon me so that I buy your product B. You come to me, you call me, you email me, you engage with me on social media, you adopt different channels to interact with me, to help me in my decision making, and ultimately I decide to buy your product whose price is 500 rupees. But in convincing me, in helping me take this decision, you have invested 1,000 rupees. So is it a good deal? On face value, it's not a good deal, because I've invested 1,000 rupees to acquire, you have invested 1,000 rupees to acquire me, but you have sold a product only worth 500 rupees. So on face value, it doesn't look to be a good deal. But what we are talking about is the lifetime value of the customer. So once you acquire me, once you make me your customer, I will not buy only a single product. Maybe after 2 months I will buy another product worth 500 rupees. Maybe after 1 year I will buy another product worth 1,000 rupees. So over a lifetime I will end up buying more than what is the price that you actually took to acquire me, right? To convince me. So this is what have to find out, what is your cost of acquiring customers and what is the lifetime value of the customer. And once you are calculating the lifetime value of the customer, again a lot of factors have to be taken into consideration. But lifetime value means what is the worth of product that the customer is going to buy over the entire lifetime. This is one factor which is very, very important. Now the next thing is rate of adding of new paying customer. Pretty clear from here, the rate at which you are adding customers. So you will see many of the companies talking about during this period, they added this many customers, they had this many signups which happened in in the past 1 or 2 months. So they're basically talking about how many customers they have actually added, or maybe how many number of paying customers that they have added. Number of rate of users signing up, this is again one very important factor. So all these factors are taken into consideration inside this bigger head customer traction while you are doing the valuation for an early stage startup. Exit potential. Now exit potential is again very, very important, right? And so exit potential in terms of whether the investor who actually invests in your startup will actually get that chance of selling away his equity, selling away his ownership, and going away with some sort of a profit. And that can happen only if you have a good future, if you have a good market coming up, your product is very nice, you can grow forward in 2 or 3 years, and the investors have got a good exit potential with them. So this is also taken into consideration while you are while you are doing the valuation. Board of directors and advisors, the kind of board of directors and advisors you have, it also plays a very important role, because that speaks volumes about the kind of advice that you are actually getting. And a good a board of directors, good set of advisors can actually steer your way through any kind of problems as well. So that gives a lot of confidence to the investors, and that increases your valuation as well. So this factor is also taken into consideration while you're doing a valuation for your early stage startup. The next one is the deal factors. Now deal factors, they are those factors which an investor takes into consideration, considering the financial and control attractiveness, right? So deal factors, again, coming back to the pre-money valuation, the kind of valuation that you have, what is the pre-money valuation that you have and the investment amount that you are trying to raise. This is one of the deal factors, right? Deal factors means once you go for the deal, then what factors are taken into account. The second thing is the term sheet deal points. Now term sheet we are going to study very, very elaborately in the next videos to come. But term sheets include preferred share, control rights, etc., etc. All these things are included inside the term sheet. So many a times you must be hearing, if you're working for a startup, you must be hearing every time and now that if that startup is going to raise some funds, your boss will be telling to we are going to file the term sheet. The term sheet is going to get closed. Now what does this term sheet include? Term sheet includes all the all the rights and the privileges that you are actually giving it to the investors. These include preferred shares. Preferred shares is what we are going to talk about, right? So preferred shares have got a higher importance given as compared to the common shares that you release, right? Importance in terms of liquidation preferences and other privileges as well. And second thing is the control rights, like seat inside the board of directors, voting rights on key decisions, etc., etc. So all these all these extra things that you give it to the investor to lure him for the money that he or she is actually giving you are actually listed inside the term sheet. So term sheet becomes very, very important for a startup. The another factor which is usually taken into account inside deal factor is the amount which is already invested inside the startup. So if you have already raised a lot of amount, so that gives the confidence to the investors who are coming up, right? They feel confident, since this startup has already raised this much amount, so it must be having that much of potential, because the other people are actually trusting. This is typical herd mindset. You can actually understand it in this way. Right, if five good investors have already invested, sixth one will think that since five have invested, so let me also invest. He feels confident about that. So this is one factor again which is important. Stage of a startup is again one factor, whether you are into the ideation phase, the product development stage, or what stage. Whether you have already acquired customers, you are developing your product, you have already developed your product, you are into ideation phase. All these factors are taken into consideration, right? Hmm, while you're doing valuation for an early stage startup. The other factors include micro environment factors. Now, micro environment factors is again very important. Macro environment factors include industry trends. In the macro environment factors means what's happening inside the industry as such, right? It's not related to a particular startup, but overall industry is taken into account. Likewise, FMCG, right? Or maybe manufacturing, right? Or maybe pharmaceutical, right? So overall, what is happening? What are the industry trends, right? Economy means how is your country doing, right? What are the political scenario inside the country, that is also taken into consideration. What are the regulatory atmosphere, right? So you must have heard that after in the 1990s, liberalization, globalization, and privatization came up, and it opened up ways for a number of companies to start investing in India. So these were basically the regulatory policies changed, right? And they actually promoted the investors to come in India, and to invest in India, and that is why a lot of foreign companies came up. Job opportunities started opening up, and etc. and etc. So all these factors are also taken into account while doing the valuation. Then your local environment factors. Local environment factors means, first thing is the comps. Comps means the comparable startups which are there in the same field, and if they have raised the funding. So again, the herd mindset, right? So if you have got a number of startups in the same category, in which you are serving, and they have raised funding, it gives an indication that even you can raise funding, right? So this is although it's not always true, but this is one factor which is taken into consideration. Recent exits, so exit potential we are talking about. So whether the startups which are into the same market, into the same category of things that you're doing, have exited. So the third thing is the saturation. Saturation means is the number of startups competing for limited amount of investment. So the investment is always limited, right? X amount of investment. So if you have got 5 startups, you've got 7 startups. Obviously, if you have 7 startups competing for the same amount of investment X, the competition is really, really very high. So maybe you have to shell out a large amount of equity just to raise a small amount of capital. So if the competition is very high, so all these factors are taken into account while doing the valuation of an early stage startup. What comes before? This is $1 million question. What comes before? So my answer is valuation comes before. So first of all, you do a valuation, and then you divide that valuation by the total number of shares that you want to have, and then you get the share price, right? So first of all, you do the valuation, and then you divide it by the number of shares, so you come up with the share price. So valuation is done first. So valuation comes before. Now we are going to study some of the early stage valuation methods, and you know these methods are really very helpful while you're doing valuation for an early stage startup. So we shall see them one by one.
Now, the first early stage valuation method that we're going to talk about is the market comp valuation method. Let us see what is it all about, and let us see how this method is being used to actually value your startup, to bring, to find out the value that your startup has right now.
The first one is the market comp valuation method. Market comp valuation method means you're going to talk about comparables. Let us see what does it means, or if you're using market comp valuation method. So the first step in this method is that you create a short profile of your startup. So you've got a startup, you have to create a short profile of your startup, and this short profile should include following things. First is that industry in which your startup is there, niche which your startup is actually serving. So inside a particular industry, if this is, this is the industry, if you are serving a particular niche, right, a particular segment of this industry, you have to find out that as well, right? The third thing is the customer status. Customer status means, do you have paying customer? If you have paying customer, what is the number of paying customers do you have? So all this information will come inside customer status. Location, where is your startup located, or where, to be very accurate, where is the head office of your startup located? Where are, the main operations are actually located for your startup? Whether it's a B2B or a B2C startup. B2B means you are serving businesses, right? So it's your company to the other company, or your business to another business. That is called B2B. And B2C means your company to all the, the customers that you have, right? The retail customers. If I have to talk it in very layman terms, the retail customers. So whether it's a B2B or B2C, that also needs to be there. Stage of development. Stage of development is another important point that has to be taken into consideration. Stage of development means like whether, your product is already developed, your product is under development, or the development has not yet started, it's still in the ideation phase. So everything will come inside, this particular, profile parameter. Funding status means like whether you have already been funded. If that is the case, what is the kind of funding and what is the kind of investors who are involved. The other extreme can be, you have not yet been funded, but this is the first time you are approaching for a funding. Valuation, your pre-money valuation. What is the pre-money valuation that you have? That is another thing. Founders experience, as we already know, like it actually counts about the past experience of the founders, whether they have been involved in the startup, or they have got some experience of exiting from a startup, so all that experience will actually count. If they have not been involved in a startup, what kind of a sector they have actually worked in before actually doing this startup. So all these profile parameters have to be considered while you are building up the short profile for your startup. Now once you build up this short profile, what you have to do is that you have to find out similar startups with known valuations. So once you have built up a short profile, find out similar startups, whose valuations are known. And for finding out similar startups, you can, you can find them through various sources, and some of these sources include Angel.co, Crunchbase.com, Gus.com, Hacker News, and many other. This is not exhaustive list, right? You can find it from a number of other places as well. Once you have found out, a similar startup, similarity means in terms of the attributes. So whatever profile of your startup that you have created, you have to find out those startups which are very much similar in these profile attributes, right? In these profile attributes. So that will reflect the similarity. And once you have found out, the closest one, right? The closest one which matches to the attributes. Now make some adjustments for large and obvious differences. Likewise, you got this was your startup profile that you created, but you got the nearest one to be this startup. Let us suppose the B startup is the nearest one and A is your startup. So almost every parameter is almost similar except for one. Let us suppose the number of paying customers. You have got X and they have got 3x or maybe like 2x. So make adjustments in your valuation. Let's suppose you've got a valuation of 1 lakh, but all the parameters are similar, but just the number of paying customers you have is X and the other one is having 2x, and they have got a valuation of, let us suppose, 3 lakhs, right? So if they have got a valuation of 3 lakhs and all the parameters are similar to them, and just the paying customers is like they have got 2 times, so you may adjust it somewhere around 1.5 lakhs or 2 lakhs. So this is what is the meaning of the adjustment. This is not accurate what I'm talking about, but this is what is the essence of saying that you have to make some adjustments for the large and the obvious differences which are there. But that happens once you have decided on the most close startup, right, which actually matches most of the attributes that you have listed down while creating a short profile for your own startup. Now, once you do that, you can easily find out the valuation. So what we did is that we actually wrote down a short profile of your startup, and then you found out the startup which most of it, most of the profile parameters matches to it, and then you made some adjustments, for large and obvious differences, and then you came out with a valuation V. This startup was having valuation of V dash, so you came out with a valuation V, right? So this is what is market comp valuation method of valuation is. This is usually used in case of startups, but there are some of the points which have to be kept in mind while using this method. The first thing is always try to use this valuation method along with other valuation methods. So it's always advisable, right? While you're using this method, always try to use other methods as well to come out with valuation. It is more useful for startups which lie in high startup activity areas, as it will be used as it will be easier to find similar startups in these areas. So if you're a startup, if the main operation is in a particular area A, where nearby to them there are not many startups, or maybe there are no startups which is serving your industry or your niche, so it becomes very difficult to find out a similar startup, right? As compared to that area, let us suppose areas in India like Bangalore or Hyderabad or something, which have got a high density of startups, in that particular area. So if your startup is located here, you can easily, find out some startup which is located nearby to you, and is very much similar in terms of the profile attributes that you have actually listed. So that is why it's usually said that it's useful for startups which lie in high startup activity area, as it will be easier to find similar startups in those areas. The next point is such valuations are okay, but make it a point to determine how will you differentiate your startups in the market in terms of your team, your ability to execute, technology and intellectual property, that is IP, market timing, and the funding plan. So, if you see this entire method, what you have done is that you have found out a very similar startup, and then, on the basis of its valuation, you have decided your own valuation by adjusting for, some large and considerable differences that you actually saw over there by after adjusting for that. But then, once you use this method, you have to be clear about, some of your differentiation points as well. Differentiation points in terms of your team, right? What are, the important points about your team, the differentiating things, your ability to execute, your technology and your intellectual property, how they are, different, and how they're going to make things easier for customers. Whether it's a breakthrough kind of a technology or it's just a good to have kind of a thing. Market timing, the timing at which you are entering the market. Funding plan, what is your funding plan? So, on one hand, you are using a valuation method which actually helps you value your startup on the basis of the valuation of a similar startup. But then, while you are in front of the investors, you should be clear about, what are your differentiating points, right? And the differentiating points can be with respect to these all points that have been listed over there. But again, this is not exhaustive. This is not exhaustive. You can come out with your own points as well.
And now we are going to talk about the Berkus method of early stage startup valuation. An interesting name, and so it's a very interesting method. Let us go and look into this method as such.
The next method which we are going to study over here is the Berkus method of early stage valuation. Berkus method is also a very famous method. It is being used for a very long time, for the valuation of early stage startup. Now see what happens in this case. In this case, the first step is to identify all the factors which shall affect your startup valuation and rate your startup on these valuation factors. So the first step is write down all the factors, right? A, B, C, D, E, F, so on, which can affect the valuation of your startup. And once you have written down all the factors, what you have to do is that you have to write down whether it's there in your startup or not, if there in your startup or not. So first thing is that you have to do an industry study and find out all the factors which affects the valuation of startups like you, and then you have to write down whether you have it or not, you have it or not, you have it or not. Let us suppose one of the factors can be paying customers, right? Paying customers. So you can write whether you have it or you don't have it. An intellectual property, maybe a patented kind of a technology, whether you have it or not have it. Similarly, a number of factors, whether the product has been developed, right, and an MVP has been ready, whether yes or whether no. This is what you have to find it out. Now, once you do that, if you have got yes, put a figure in front of it. If you have got no, then it's obviously 0. So if you see here, I have listed down some of the factors, like you have a scalable business model. If it is yes, it is yes in this case. So you added $50,000 over here. Paying customer, you don't have paying customer, so the value is 0. MVP developed, that is a minimum viability product has been developed. Yes, it is developed, so you add $25,000 over here. Founders have previous exit experience, means founders have done a startup and then they have exited as well, so they have got an experience in exiting established a startup. If they have got no experience in that, so the value is 0, and so on, right? And once you do that, you add all these values, and once you add all these values, the resultant value that you get becomes the pre-money valuation of your startup, becomes the pre-money valuation of your startup. So this is what is written it over here. Calculate the total to the pre-money valuation to arrive at a final pre-money valuation. So, add all the values to find out the final pre-money valuation. Now, there is one point which is very, very important, right? You write down all the factors, right? You write yes or no against it, but there will be, some investors who will consider one factor to be a make or break, and will not consider any factor in action. So let us suppose, you have written down, A factor, B factor, C, D, E, F, and, A was yes, so you wrote a value X, Y value, yes, even C was yes, D was yes, E was also yes, but F was no, right? Value Z, W, capital A, so on, but this was 0. So maybe the summation of these all values comes out to be very high, or maybe very attractive for the investors, but there will be some of the investors who will consider some particular point. Let us suppose he or she considered this point F, which for him or her is very important to invest, but on this factor F you have got a no, so your value is 0. So this can be a case. So one so that is why what happens is that companies, when going for investment, they do a study in very deep, they do a deep analysis of what kind of investors will be present inside over there, what kind of investors are there to whom they are going to pitch, and on the basis of that they jot down the factors. So reverse engineering is also there in many of the cases, and it's a good thing to have, because for some of the investors, one of the factors may become the most important thing to decide or reject a particular startup. So it's always good, it's always advisable to have a good amount of a study about the portfolio of those investors, see what kind of investments that they have done in the past, what are the important parameters that they do take into consideration while investing in a startup. And once you have that study with you, right, it becomes very easy for you to write down all the factors which will create a great impact on that investor, and your chances of raising funds increases considerably.
Now we're going to talk about the risk mitigation valuation method. It's a valuation method which actually focuses on how do you mitigate the risk which is being associated with your startup. Let us deep dive into that, and I'm going to meet you just on the other side of this session.
Now the next method which we are going to study is risk mitigation valuation method. So in this case, what you have to do is that create a list of all the accomplishments of your startup. So whatever accomplishments that you had for your startup, you have to write down all the accomplishments, and then divide the accomplishments into 4 risk mitigation categories. So basically this method is that like if you have achieved some accomplishment, if you've achieved some milestones, your risk automatically decrease. Likewise, you have paying customers, so your risk decreases. You have got a fully developed product, your risk decreases. And we already know that as the risk decreases, your pre-money valuation shoots up, right? Because you become more trustworthy in the eyes of your investors. So this is the basic premise which this particular method uses. So create a list of all the accomplishments and then divide those accomplishments into 4 different categories. They can be risk mitigation category, into 4 risk mitigation categories, and these categories include technology, market, execution, and capital. So technology, market, execution, and capital are the 4 categories in which you should list down all your accomplishments. So I've got, let's suppose you've got A, B, C, D, E, F accomplishments. So you've got 6 accomplishments. So there's technology, market, execution, and capital. So let's suppose in technology it's C and D, in markets it's E and F, in execution it's A, and in capital it's B, let us say, right? So this is what you did. You wrote down all your accomplishments and divided the accomplishments into 4 different categories. And those categories are technology, market, execution, and capital. Now, once you do that, what you do is that next is assign a value to each task or accomplishment in the list. So, C, you assigned a value, let us suppose X dollars, D, you assigned Y dollars, E, you assigned Z dollars, so on. You have to assign a value and then add all these values to come out with a particular figure, let us suppose capital X, which becomes your pre-money valuation, right? So this is how, so there's a difference, between the previous method that we studied, where, you were writing all the factors, which actually affects the valuation of any startup like you, and then you're writing yes and no, and if yes, you're writing a value against that. In this case, you're writing the actual achievements or, accomplishments of your startup, and then you're dividing it into 4 different categories, and then you are assigning value to each of these accomplishments, and then you're adding all these values to come out with a final pre-money valuation. Now, there are some considerations which you should have in your mind while you're using this method. So, while considering technology valuation means, one of the 4 categories, if you remember, the risk mitigation categories, one of them was technology. So, once you're considering technology, you should keep in your mind that innovation without a market is not valued by the investor. So, you have innovated a big product, but it's not required inside the market. The people don't have any need of that, right? So, it's not valued by the investor. R&D leads to significant barriers to entry. Now, this means that, if you have got good patents, if you have a, good team of people who are continuously researching, about, the better products, this creates a significant barrier to entry. So, most of the companies consider innovation, to be one of their core values, right? Why? Because if they innovate, they will be, always coming out with better product, and, it creates significant barrier, for, of entry for the other companies, right? So this is one thing which has to be, if you have got good patents, good IPs, this intellectual property, I mean, this creates a good impression in front of your investors. The third thing is that market size for innovation is very important, and these 2 points are very much, related, right? So you've got a market for your innovation, but then you should have a good decent market size, for that innovation. If you have a very small market size, it's again not that attractive, right? So you should have a good market size for that innovation. So while you are considering, technology category, these 3 points have to be taken into consideration. Now, sanity check. Sanity check, while you're using this method, you need to have, one point in your mind is that check if you have not undervalued or overvalued some of the factors. So you should not, while you're assigning, values for A, B, C, D, so on up to E, F, right? You should not overvalue or undervalue something, right? Likewise, I will just take an example. Let us suppose, one of these is the lifetime value of customer. So lifetime value of customer, you can assume your customer to remain with you for 10 years, and then you can also assume your customer to remain with you for 50 years. 50 years seems to be very far-fetched, right? If you see 50 years, you may come out with a lifetime value of the customer to be 1 lakh. If you take 10 years, the lifetime value may be, somewhere around maybe anything like 20,000, let us suppose. But 50 years seem to be very far-fetched, right? And if you're assigning 1 lakh, rupees value to the lifetime value of the customer, considering that you are taking the lifetime period of that customer to be 50 years, that 50 years that customer will remain with you, this seems to be very much overvalued. So all these things have to be taken into consideration while you're using this method. And the sanity check is, again, a very important thing.
Now, we are going to study about VC quick method. VC quick method means in this method, you're basically thinking from the perspective of the VC. And that is what makes this method very special. Let us go and see it, and let us also do some examples to understand this method pretty well. I'm going to meet you just on the other side of the session. Stay tuned.
Now, the next method is VC quick method. So it's more about, this method is more about, thinking from the perspective of the VC. So that's why it's known as VC quick method. Now, in this case, the first step that you need to have is that, the first of all, you have to find out what is the amount of money that you need and for a particular period of time. So likewise here, I've taken an example, like, how much money do you need for, say, 12 months? And this is where you found out is that you need 20 lakh dollars US dollars for the coming 12 months. So this is the amount of money that you actually need. Understand how much equity the VC wants, for giving you this much money. So let's suppose, for giving you 20 lakh US dollars, the VC wants 15%. So this is some figure which you should know beforehand, right? Like if I want this much of an investment, what will be the VC's expectation? And this figure can be found out, by studying the whole portfolio of a particular VC, that is venture capitalist, the investor who is there. On the basis of the previous investment that he or she has made, you can find out, what is the percentage of equity share that the particular VC asks for investing, this much amount of money. Once you have these two figures in mind, that is, you have got this figure that, for an investment of 20 lakh US dollars, you have to give 15% to the VC. This means that your post money valuation is nothing but 20 lakh divided by 15%, that is 20 lakh divided by 0.15. So this comes out to be 133 lakh US dollars. It comes out to be 133 lakh US dollars because, you have got, 15% is 20 lakh. So what will be 100%? So that will be 133 lakh US dollars. So that is why you divide it by 0.15. So you got your post money valuation, and once you have got your post money valuation, you have got nothing to do. You just subtract the investment amount from here to get the pre-money valuation. So what was the investment amount? Investment amount was 20 lakh dollars. So you subtract 20 lakh dollars from 133 lakh dollars, and you get 11 lakh something 113 lakh dollars from here. So this is how you can find out the pre-money valuation. So this method started with what is your investment need for a given period of time, and on the basis of your study about the portfolio of the VCs or the investor, how much equity those VCs or investor want for investing this much particular amount, that is 20 lakh dollars in a particular startup, right? And once you have these two figures with you, you can find out your post money valuation. You have your post money valuation, you subtract the investment amount, that is 20 lakh dollars in this case, to get the pre money valuation. So this becomes so simple. Now there are many other fundraising deal factors like liquidation preferences, anti-dilution provisions, and board sheets, etc., which are usually taken into account. So we have already studied that valuation is one question. Valuation is one of the factors. The other factors include whether the investor is going to have a seat inside the board of directors, whether the investor is going to have some liquidation preferences, whether he or she is going to have some preferred share, or his shares have got some anti-dilution provisions. All these factors also the VCs or the investors will take into account, and these all come into deal factors, which we have already studied, and we'll be learning about these all terms in details in the coming videos as well. Now there are some of the considerations which you should take, which you should make or have once you are using VC quick method for evaluating the valuation of your startup. The first thing is that startup has moved from early stage of product development and customer delivery. This method should usually be used for those startups which have already developed their product and have entered into customer delivery, right? So they have somewhat matured, right? They have got a product ready, they have got some paying customers, their operations are functional, and they're increasing, they're expanding. Once your startup is on a little bit of track, then only you should think about using this method. Second consideration is you should have a good understanding of the key metrics that drive your business. These include cost to acquire each customer, what your customer churn rate is, what is the lifetime value of a typical customer, etc., etc. So as from the first consideration, it's very much clear that once your startup is on track, right, your operations have started, and then only you will have a good idea about the key metrics which are driving your business, and these metrics include cost to acquire customers. We have studied cost to acquire customer in detail in the previous videos. What is your customer churn rate? Customer churn rate means the rate at which customers leave you, right? That is called customer churn rate. Lifetime value of customer, again, we have studied it in the previous videos. So once your startup is on track, once the operations are functional, and then only you will be in a good position to actually determine these key metrics. So this second factor results from the first factor. And the third factor is also again related. Your startup should have a stable operations and a complete team. And the fourth thing is that funding needs are well understood. Funding needs are well understood means you knew that for 12 months you needed 20 lakh US dollars. How can you be so clear about this thing? You can be clear about this thing only if your startup is operational, is running, you have got some key metrics at your hand in place, and this is what my planning is going to be, to actually increase the geographical area which this startup is serving, or maybe to increase, to increase the team, maybe to diversify the product, etc., etc. And that is why you have, a clear picture of the funds that you will be needing in the coming 12 months. So your funding needs are well understood. This is one, again, consideration. So basically, these four things denote only one thing, that your startup should be functional, it should be operational, it should have, key metrics. You should have key metrics in your hand. It should not be, your product should be developed. It should not be into a very early stage if you want to use this method, that is VC quick method.
Now we are going to talk about VC valuation method. This is the last method that we're going to talk about as far as early stage startup valuation goes. I hope you must have got, all the methods in totality. Everything must be clear in your mind. If it's not clear, please go back and watch the session again and let me know inside the comment section if you have got any doubts. I would like to clear it as soon as possible, because doubts inside mind are not that good. Let me, meet you on the other side of the session, and for the time being, you do watch this session on VC valuation method.
The next method which is used is the VC valuation method. Now, this method is usually used by the VCs, or the investors, to actually find out what is the valuation of your startup will be, right? But you should also have an idea about, how is this method being used, right? So that, you can use your own methods to actually, bring out a valuation which should be comparable to, what is being derived from here. This is VC valuation method, usually used by VCs. So, we'll see a brief overview of this method. So the exit value of a startup is assumed and then worked backwards to calculate what your startup must be worth now based on that exit value and expected ROI. Right. So, so you've got a pre-money valuation with you. And on that valuation, the investor invested some X amount. Let us suppose it invested some X amount. And, 10 years, and the pre-money valuation was, let us suppose, X. Sorry, since we've already assumed X for the investment. So let us take it to be capital A. The pre-money valuation was capital A. And at that point, the investor invested X amount in your startup. Now, after 10 years, this investor wants to exit. Exit means he or she wants to sell the shares and just, come out of that startup. And let's suppose after 10 years, the value becomes 3A. So obviously this X would have become 3X. So basically this investor has earned 2X returns, and 2X returns on X means what? Kind of a 200% return on his investment. This is what is called ROI, right? ROI is what this. ROI is final value of your investment divided by the initial value. So in this case, ROI will be 3 divided by 1, that is 3. So your investment is becoming 3 times, right? This is what is your ROI. Now, this is what kicks in over here, is that you determine your ROI, right? You determine your ROI. So let us suppose, I'm an investor. So I'm going to invest, 10 lakh rupees, 10 lakh rupees, and I need an ROI of 20. So I want this thing to become 200 lakh in a period of 10 years, let us suppose. In a period of 10 years. Right. So on the basis of this 200 lakh, let us suppose, I've got 10% equity. So this will also remain 10% equity. So 10% is 200 lakh, means 100% will be 2000 lakh. So this should be the value of the startup at the end of 10 years from here. Then only I will make it 200 lakh. Now, if I know, that 2000 lakh is going to be the value of the startup after 10 years, I have to find out its value over here. So what has happened is that 10 lakh has become 20 times. So if you reduce it by 20 times, so it's going to become 100 lakh. So 100 lakh should be the valuation right now, if you understood it very well, right? So what I need is that I need an ROI. And if we have that ROI, I can find out what is the final exit amount that I want. If you have that final exit amount, you can find out the final value that the startup should have. And if you have the final value of the startup, you can find out the valuation of the startup right now, which you are looking for. And if if you as a founder has actually made the valuation to be, let's suppose 50 lakhs, I won't be investing in you, because I want, this will turn out to be 1,000 lakhs only, but I want 2,000 lakh at the end of 10 years. I'm not getting a 20 ROI, right? So I'll not invest in your startup. So this is this is in very layman terms. I've tried to make you understand what is, how this evaluation method actually works. We now we will see the literature part of it, right? So the exit value of the startup is assumed, and then walk backwards to calculate what your startup must be worth now based on the exit value and the expected ROI. It is useful for startups. Now again, a kind of a consideration. It is useful for startups with couple of years of full operations. Likewise, it was in case of VC quick method. Your operations should be functional. You should be at least a couple of years of operations should be there, because when that happens, it actually becomes easier to actually predict the earnings or profits. As this method uses financial projections of the startup, especially the annual revenues in the year of a startup's exit, and can also make use of P by E data for companies in similar sectors. So since you're using the exit value of the startup, which was like 2,000 lakhs, so it's based on the financial projections. And how can you make financial projections better? How can you make revenue projections better? Is that if you are into some sort of an operations, you have some key metrics in your hand, you have some data in your hand, right, for your startup. And when can that happen? If you are into 1 or 2 years of a couple of years into operations. If you're not operational, you don't have any data, you cannot do any financial projection of your startup, if you don't have any data. So that is why it is very important for your startup to be having at least a couple of years of full operations for being able to use this method. It incorporates ROI expectations from the investor. We have already seen this. It incorporates ROI expectations from the investor. Now we'll see it step by step, how this method actually works. The first thing is that you have to understand that exit value divided by post money valuation is the desired ROI multiple, right? Exit value divided by post money valuation is the desired ROI multiple. Likewise, I was talking about, this is 100 lakhs and this becomes 2,000 lakhs. So this is the exit value, and this is the post money valuation, and this 20 is basically the ROI multiple. Like, why? Because 2000 divided by 100 becomes 20. So 20 is the ROI multiple. So exit value divided by post money valuation is the investor desired ROI multiple, right? So if you just interchange this equation, you'll find out post money valuation is equals to exit value divided by investor desired ROI multiple. Now, how can you determine the exit value? So for determining the post money valuation, you should know the exit value and the investor desired ROI multiple. How can you calculate the exit value? So exit value can be calculated, right? This is the exit value. So how can you calculate the exit value? So you can use a number of methods. The first method is that you have to use the industry trends. So let us suppose there has been an industry trend that startups which are in the similar area of operations as you are in, they get acquired at 3x of their annual revenue. So what is mean is that startups, the previous experiences suggest that the startups which were in your space, right, got acquired for 3x. Means if they were having 20 lakh revenue in the final year, they got acquired for 60 lakhs. This is what it means, right? So if you have gotten revenue over here, you can project your revenue here, and then you can multiply it with 3. If that comes out to be equals to 2000, this is an ideal, or more than 2000. It's an ideal condition. So the first thing, the first method of finding out an exit potential is to study the startups which are in your space, and to see like at what value they got acquired, and what multiple of some particular parameter of that startup is that value. Let us suppose 3x of the annual revenue. The second method is using the P by E multiple for your industry space. So there are, every industry has got its own specific P by E multiple. P by E means price divided by earnings ratio, which we will be studying in details in the later videos to come. But just for your understanding, we can use the P by E multiple as well, to find out the exit value. So as in this case, we are taking an example like, so, so we have to use the P by E multiple, to find out the exit value of the startup, right? So ROS, that is return on sales percent. What is this? This is before tax earnings of your on your revenues. So let us suppose you have got a before tax revenue of 100 lakhs, and your return on sales means this is your earnings. Like return on sales is actually 20%. So means you are earning 20 lakh rupees, right? So return on sales percent, that is your before tax earnings of your revenue into exit year revenue, right? Exit year revenue, let us suppose, is 100 lakhs, right? So if you multiply that, you get the exact earnings. And if once you have got the exact earnings, let us suppose here the ROS was 20% and the exit year revenue was 20 lakh dollars. So if you multiply it, you got $4 lakh as your earnings, and $4 lakh when multiplied with P by E multiple. So P by E multiple here is taken as 10. P by E multiple is specific for a particular industry. So let us suppose for this industry where this startup is, the P by E multiple is 10. So if you multiply this, you get 40 lakh US dollars, and that becomes your exit value. That becomes your exit value. So once you have got your exit value and you know the ROI multiple, the investor has told that, I need an ROI of 20. You divide it by 20, so you get 2 lakh US dollars, and 2 lakh US dollars become your post money valuation. And you've got your post money valuation, you just have to subtract the investment amount. The investment amount, let us suppose, is $50,000. So $1,50,000 becomes your pre money valuation. Right. And if you have got your pre money valuation, you have got your post money valuation. So you will divide the investment that the investor has done divided by post money valuation to find out the equity stake of the investor. So step by step, you understood, how do we calculate, right? The first thing is that you determine the exit value, right? Exit value, right? Not the value in the beginning, but the value at the end when the investor wants to exit the startup. Exit the startup means wants to sell his shares and come out of the startup. What is the exit value? Exit value can be determined with the help of studying industry trends, and the second is by using P by E multiple. And once you have the exit value and the ROI multiple is being given by the investor, if their ROI multiple, you can find out even by studying the portfolio of an investor or maybe having a talk with them, right? So if you divide by ROI multiple, you get the post money valuation, and once you get the post money valuation, you subtract the investment amount to get a pre money valuation, right? So this is how this entire thing actually works, and this makes it very, very simple to understand. Now, there are some of the considerations that you should use while using this method. The first thing is you have to understand the VC mindset in terms of ROI expectation. As we've already taken this point into consideration, that you should have an idea about what is the ROI expectation of the VC. Second thing is that you should be able to check the exit value precisely. The exit value should be predicted precisely, so whether you have to use the PE multiple or you have to study the industry trends, you have to take it in 3x or 4x of what the revenue projections and all, everything have to be very much precise, right? So there are two things which have to be taken into consideration. The first thing is you should be clear about the ROI expectation of the VC, and second is that you should be able to calculate the exit value.
Now, the last topic of this particular course is the impact of option pool on your valuation. How does option pool impact your valuation? The first thing we'll study about what is an option pool all about, and then with the help of an example, we are going to see its impact on your valuation, on the valuation of your startup. Stay tuned, guys, and I'm just going to meet you just after this session. Remain with me.
Now we're going to see another topic, which is the impact of option pool on valuation. So option pool are basically created for employees, which we are going to study in details about in the next videos. What is this option pool all about? But we will just see the impact that it has on your valuation. So it's basically in a nutshell is whether you're taking in the option pool pre-valuation or post-valuation. We'll see this. So this all makes the difference whether you have taken option pool before investment or after investment. That is one thing. So to say investors will always want option pool to be there before investment, and founders will always want option pool to be there after investment. Now, it refers to the effect of on the pre-money valuation when you create a stock option pool out of founder's equity prior to any funding done by the investor. It can be created pre-money as well as post-money, as we told. In case of pre-money, the founders take the entire burden for the option pool, and that is why they are against it. They want the option pool to be generated after the investment has been done, so that even the investors take that burden, right? If it is done before investment, the founders take the entire burden of that option pool, and that is not considered uh, you know good by the founders. We'll take an example. This will make you understand. So let us take a the pre-money valuation calculation. We'll take an example of it. So let us suppose that you have got a pre-money valuation of 10 lakh US dollars. So you have got a pre-money valuation of 10 lakh US dollars, and it includes a reserve of 20% of option pool. So means 20% of 10 lakh US dollars is being reserved as an option pool on this pre-money valuation. Now you went for an investment, right? And the investors agreed on a pre-money valuation of 10 lakh US dollars, and they decided to invest 3 lakh US dollars with your startup. And the investors are also asking for a 20% option pool. So investors told that, okay, we are okay with a pre-money valuation of 10 lakh US dollars. We're going to invest 3 lakh US dollars in your startup, and we want a 20% option pool. But here is the catch: do you want an option pool before your investment, or do you want it after your investment? And the investors told that we want it before the investment. We want before the investment. So see, what happens is that the pre-money valuation is 10 lakh US dollars. The raise amount is 3 lakh US dollars. So your post-money valuation will become this pre-money valuation plus investment. So post-money valuation, as we have already seen, is nothing but pre-money valuation plus investment. Pre-money valuation plus investment gives you post-money valuation. So what will be your investor ownership? Investor ownership will be the amount of money that he has invested, at $3 lakh, divided by post-money valuation. So this comes out to be 23.1%. It looks to be 23.1% as per our calculation. But actually 20% of the pre-money valuation was on option pool. Means it was not a founder's equity actually. It was being saved for your employees, because option pools are being created for the employees. So 20% of 10 lakh US dollars means 2 lakh US dollars was actually reserved for the employees. So the true pre-money valuation, if you talk about, will be equals to negotiated pre-money valuation minus option pool, that is 10 lakh minus 2 lakh, that is 8 lakh US dollars, is your actual true pre-money valuation. And if you calculate the investor's equity on this, it will become 3 lakh divided by 8 lakh, and that comes out to be 27.5%. So instead of 23.1%, it is actually 27.5% if you take the impact of option pool over here. So option pool makes a lot of difference, right? While you are calculating the equity which the investors will have, and whether it is pre or post investment, that also makes a lot of difference. Now we'll see, many a times, the investors will pose some questions to you. The first of the question is, your valuation is too high, and you should be ready with points, to prove that your valuation is not high, but it's actually justified. So you should have points, to justify your valuation. Second is the investment fund criteria. The third one is, they will ask for more equity, and the fourth one is they will ask for more control. Investment fund criteria means, they will put up, some points, which they will want to have if they invest in your startup. So, that is basically, their requirements in order to invest in your startup. More equity is what they want. More equity means, they will invest a particular amount of money, but they want more equity. Means they are trying to reduce your pre-money valuation, right? More control means they want a seat in the board of directors, they want preference shares, they want liquidation preferences, they want voting rights, etc., etc. So you should be ready, to counter all these points once you are going for an investment. One of the things which is usually, which early stage startups face is that, this point that your revenue doesn't support your valuation. Means, they will be in the very early stage of their operations, and the valuation that they have created, it doesn't justifies the revenues that they have at present. So you should be ready, to counter this argument as well. And that is why we have studied, different methods of valuation. The third thing is the you are too early and too early concept that we have already studied, that you should never go for an investment in the early part of your startup, because in the very early part you will end up giving out more equity stake at a lesser investment, which becomes very difficult to be justified once you go for the subsequent round of investment. So you should not be too early, right, into.
Congratulations! Now you know everything about startup, earliest stage startup valuation. And remember, guys, these all methods are used during the early stage of your startup. And this is very useful for people who have just done a startup and who just want to raise funds now, because funds are really important to scale your startup in the way that you want. It's very useful for people who are startup enthusiasts who do want to track what does a particular startup doing in this particular space, for people who want to know about different terms and terminologies involved inside the startup space, for people who want to know about the valuation methods which are used especially for doing the valuation of early stage startups, and for everybody out there whosoever is interested in gaining this knowledge of startups. This course is meant for you. Please don't forget to put inside the comment section if you have got any doubts, any clarifications, any other information that you need. I'll be more than happy to help you out with whatever I can do for you. Thank you, take care, and it was a pleasure to share this course with you all people. Thank you.